Good morning, everyone. This side Shweta Shaw from Tax Connect. We welcome you all to the monthly updates on direct taxes. Further, I'd like to introduce our speakers, Mr. Vivek Jalan and Mr. Rishabh Jain. They both are partners at Tax Connect Advisory Services LLP. Mr. Vivek Jalan is a qualified chartered accountant, qualified LL.M, and qualified LL.B. He is the chairperson of Indirect Tax Core Group of CII and also chairperson of Fiscal Affairs Committee of Bengal Chamber of Commerce and Industry. He is a regular speaker at various professional forums on the key areas of direct and indirect taxes. Now, I'd introduce our another speaker, Mr. Rishabh Jain. Mr. Rishabh Jain is a qualified chartered accountant, qualified CFA. He is a regular speaker at various sessions in various Chamber of Commerce. Further, I request you all, if you have any queries, please write it in the chat box and all your queries will be answered at the time of question answer session. I'd request you to mute yourself and keep your video off during the deliberation. Now, I request Mr. Vivek Jalan to take the session forward. Over to you, Vivek, sir.
Thanks, Shweta. Am I audible?
Yes,
Yes,
sir.
sir. Yes.
Yeah. And the PPT is visible, no? Yeah. Okay. So thank you, Shweta, and thank you all the participants for such an overwhelming response. We are expecting a lot more participants as the session progresses, but we would like to start on time, and that is as our in the past we have done. So we would be starting and people would be joining as and when they come. So friends, after some time, we have this monthly direct tax update session from Taxguru and Tax Connect. And henceforth, in the coming year, it would be a monthly affair. In this webcast, we would be discussing 5 key areas which we have laid down in the agenda of our webcast. However, going forward every month, we would cover almost all important areas, all developments in the direct taxes area. For indirect taxes, Tax Connect also has a separate monthly update webcast, which you can join. You would be intimated going forward. So thank you all for joining this session. And the most important thing in a webcast live one is that you can always ask your questions, and we try to answer all the questions. If we cannot, we take some time to answer, we will certainly get back post the webinar on mail. So keep typing all your questions in the chat box, and we would try to answer them at the end of the webcast. Friends, there are 5 topics today. Uh, One is the changes to the income tax returns for assessment year 22-23, which was notified on 1st of April. Next is the changes which are made in the Finance Act vis-a-vis the Finance Bill 2022. We would not discuss the entire Finance Act because most of it was covered during the budget webinars which we have had. We would cover only the changes of Finance Act 2022 vis-a-vis the Finance Bill, that is the budget 2022, only the changes therein. Uh, and we would, the most important, discuss also the crypto tax. We would cover income tax amendments which are already done, and a slight understanding on the GST implications, what we see it as of today. You all know that GST investigations are on for the cryptocurrency dealings, and the Ministry of Finance is all set in the coming days to introduce something on the GST front on crypto assets or the virtual digital assets also. So we'll discuss that also for some time today. Thereafter, Rishabh would discuss the faceless assessment scheme and an understanding on how to reply to Section 148 notices. We have seen Section 148 saw a sea change in the last Finance Act 2021, and now before it was streamlined, it has seen another sea change. So many notices across the country have been pouring under Section 148, and so it is important to understand as to how to deal with 148 notices. Same with faceless assessments. Before even getting streamlined, it has been again overall that scheme with revisional units, jurisdiction, etc. So Rishabh would discuss that. So first of all, we would discuss the changes in the income tax returns, which were notified only few days back on 1st of April 2022. As far as the capital gains is concerned, there are few changes to the income tax returns. Some of the changes are apropos the amendments which were made in Finance Act 2021 as far as the capital gains are concerned, while some are the other amendments made to the income tax returns. Most important, while we are understanding the changes to the income tax returns in detail, is that we need to understand what are the documents which we would prepare from today so that we are ready when the income tax return filing comes and when we are actually filing the income tax returns, because just disclosure is only some part of the job done, but more important is that you should have the underlying documents. You should have the data so that you are scrutiny ready while filing the income tax returns. So first of all is the disclosure of the year-on-year improvements to land and building, the year and the value. We all know while computation of the capital gains, we get three deductions. One is on the cost of acquisition or indexed cost of acquisition, as the case might be. Then is the cost of improvement, and then are the other expenses. Now, in the cost of improvement, previously you just needed to disclose one figure. That is the total cost of the improvement on the asset, that is land and building, till date. However, in this income tax returns now, while you are disclosing the capital gains, you need to disclose year on year cost of improvement. This is a very tedious job, and you need to take out from your database, especially for the in case of individuals, in case of directors of your company, partners of your organizations, etc., where you are filing the returns for them. It becomes very difficult to get the year-on-year cost of improvement, because for individuals, HUFs, unlike the companies, they do not have the data. And in case it is a very old land and building, even for the corporate assessees, it becomes difficult to get year-on-year data itself. And the documents, that is the cost of improvement underlying documents. The moment you disclose a year-on-year figure, the assessing officer, while doing the assessment, he would want to see what are the underlying documents, what is the nature of the cost of improvements which you are claiming, etc., etc. So this is a major change as far as capital gains is concerned, and we need to prepare from now on wherever there has been a transfer of assets in the form of land and building. Again, ITR 2, 3, 5, and 6 in capital gains, there is a requirement now to disclose the date of purchase as well as the date of sale of land and building. Okay, Mr. Janki, yeah, PPT would be circulated, so don't worry. So now date of purchase as well as date of sale is required to be disclosed. Very, very important. It would give understanding to the assessing officer as to whether it is a short term or a long term capital gain, and also it would help the tax authorities to verify whether the assessee is eligible for the exemption under 54, 54 EC, 54F, etc., etc. So again, the moment you disclose the date of purchase, date of sale, you should have the underlying documents which you generally have, but you have to be very, very careful as to what is the date of purchase which you are showing over here, and whether you are eligible for exemptions or not, whether you are showing the right cost of acquisitions, etc. Even indexation. So now the income tax authorities are, through the income tax returns, the CBDT is trying to keep everything in the income tax return. They don't want anything to be, asked during the assessment. They want all the data, where because of data analytics, they will put in the data analytics over there. And in case you make an arithmetical error also, then the data analytics part would automatically show up an error, and uh, maybe you would be asked questions. And nowadays it is direct 148, 148A, which I would take through. So now previously you needed to just put in the cost of acquisition or indexed cost of acquisition. If you are taking indexed cost of acquisition, you just take the indexed cost of acquisition. That is it. However, now, even if you are taking indexed cost of acquisition, you need to put in the original cost of acquisition and the indexed cost of acquisition, plus you have the date of purchase and date of sales. So now through the return form itself, the authorities will calculate they don't need to calculate also the data analytics part. They will just put in a formula, and automatically it will the from the cost of acquisition, date of purchase, date of sale, the indexed cost of acquisition will be calculated by the software itself. So they don't want to leave anything to chance. They don't want to leave any questions which would be asked and information would be taken at the time of assessment. They want to do all of this through data analytics now. In case of slump sale, again, whatever is in the law, they are just putting it in the forms and seeking more and more data in the form itself. So for slump sale, in Finance Act 2021, an amendment was made in section 50 capital B, and thereafter rule 111 11 UAE was notified, whereby the full value of consideration would deem to be the fair market value of the capital asset transferred by way of slump sale, or the fair market value of consideration received or accruing due to transfer by way of slump sale. So either fair market value of the assets which have been transferred, or the fair market value of the consideration, sorry, received. Just a second, please. Yeah. So both of these figures, in addition to the valuation which you have done under 11 UAE, that is separate, that is as per your records. But in the return also, you need to disclose both of these in the specific tabs, right? Now, again in the Finance Act 2021, there was a sea change on the in the case of assessments of partnership firms which were reconstituted or dissolved, whereby the deeming fiction was introduced, whereby the firm would be taxed under capital gains or any other head of income on the transfer of assets to the partner in case of dissolution or reconstitution of the firm under section 45(4) or 9 capital B. However, simultaneously, due to this, there was an adjustment which was required to the assets which were remaining with the organization. Okay. Under section 48, clause 3. Now, this is a welcome change in the return, that adjustment to the assets, the WDV of the assets which is remaining with the organization under 48(3), that needs to be disclosed in the return itself, and therefore it would be tracked in the return itself, so that during the time of assessment of the partnership firms, that WDV would not be a question. However, again, it is important in case of partnership firms that detailed calculation to be made, and most important in this case, since the WDV need or additional WDV needs to be reported in the return, matching of the WDV as per the books and as per the return, that is a important exercise which needs to be done. Income from other sources, again a very important amendment to the income tax return is that uh, the deemed dividend would require to be separated from the other dividends, right? So when you go to the income from other sources in the return, you have to disclose the gross value of the dividend, then bifurcate that gross value into deemed dividend under 222E and other dividend. As we all know that in case of deemed dividend, the treatment in income tax varies somewhat, and so more important is that they want to track this deemed dividend year on year now, right? Because you know that deemed dividend is for closely held companies, the loans and advances which are given to the specific shareholders, right? So they want to track this deemed dividend going forward year on year. So this is a very important amendment again, which needs to be taken care of. Now, again, in Finance Act 2021, it was laid down by amendment of section 10, subsection 11 and 12, first proviso and second proviso, that in case of the assessees who were making contribution to provident fund, which was more than 2.5 lakh per annum, the interest part over and above this 2.5 lakh per annum, and in case the employee is not making the contribution, then over and above 5 lakh rupees per annum, that interest part would be taxable. So corresponding amendments have been made to disclose specifically 10 subsection 11 first proviso second proviso, 10 subsection 12 first proviso second proviso, under which you fall, so as to make it taxable. Right. So I would request you to please mute yourself. Yeah. So again, while the CBDT is claiming that income tax returns, they would be simplified, income tax is getting simplified, of course, leave alone GST. But to disclose this or maintain this kind of an information, 10 subsection 11 first proviso, second proviso, 10 subsection 12 first proviso, second proviso, which of these you fall under, it would require a lot of analysis when you are filing, and considering that this would be the filing of a salaried person, albeit an HNI, because he is contributing more than 2.5 lakh rupees to Provident Fund, but still it would require a lot of working which needs to be done to fill in this return. In the foreign taxation, international taxation area, in the schedule of foreign assets, now this is an important change for even for transfer pricing. There was always a confusion because the foreign assets were required to be disclosed with respect to the accounting year of the foreign country. So for example, you are holding the shares in a foreign company. Okay. Say you are holding the shares of Google or Apple. Now, if the accounting year of USA, where the foreign company is located, is say from July to June, right? Or if you're holding the shares of a Japanese company, and if the accounting year of that Japanese company is from July to June, right? So when you are filing the income tax return of assessment year 22-23, you had to take the foreign assets held by the SSE between July 2020 to June 2021, because June 2022 has not ever happened in the financial year or the relevant previous year. So in case you have purchased the share of say Apple, Alphabet on say September 2021, and because the accounting year of that company is July to June, therefore the shares which were held on 31st of March 2022, that would not be disclosed because the accounting year was July to June. Now they have amended this accounting year to calendar year. So if you are holding any shares or any foreign assets in the calendar year 2021, that is till 31st of December 2022, then you need to disclose it in the return for assessment year 2022. However, if say you purchase any foreign assets in say January 2022, then you need not disclose it in this return. It will come in the next return. Now, in case NRI has a business connection through significant economic presence, then the same needs to now be disclosed in the income tax return 356, and the transactions which need to be reported are in case the NRI who has a significant economic presence deals in goods, property or services of more than 2 crores, or he deals with 3 lakh or more users. So now this significant economic presence, because there is a business connection through significant economic presence, that needs to be disclosed separately, and the transaction and the taxability will be defined accordingly. Now, in case of NRIs who have come into India for permanent settlement of India in India, there was always a problem in with respect to the pension and other retirement benefits. In case of foreign country where the retirement benefits were accruing, many a times the retirement benefits were taxed at the time of payment or the receipts. However, in India, they were taxed on accrual basis, and then therefore there was a mismatch. So in the last Finance Act 2021, Section 89 capital A was introduced, whereby this anomaly was sought to be done off with, and it was proposed that now there would be a matching and the credit of the tax paid in the foreign country would be available. However, how this credit would be available, how this matching was done, the modus operandi was not very clear. Even now it is not clear, but in the return, now there is a specific place whereby you can disclose that when under 89 capital A, you have received the money in the foreign country when it was taxed in the foreign country, and as per accrual basis, how it is taxed in India. Secondary adjustments made in transfer pricing, that now needs to be disclosed separately, and in case where any tax at the rate of 18% has been paid on secondary adjustment, they need to be disclosed separately. Now there is a small amendment which in the income tax return with respect to separate disclosure of interest and dividend incomes under section 115 AC. So now previously it was a combined disclosure with respect of bonds or GDRs purchased in foreign currency. Now they need to be disclosed separately, bonds separately, and interest on bonds separately, and dividend on GDR separately. So this is just a procedural change. It is just a disclosure change, not a major change. Now, a major change which will impact all the SSEs more or less, right? And all, including non-residents, residents. Now, in the income tax returns, you have to tick the box with respect to your residential status. So it is not just that you disclose that you are a resident, ordinarily resident, or not ordinarily resident, or non-resident. You need to state under which clause do you fall to make you a resident and ordinary resident or not ordinarily resident, right? So, residential status determining is a tedious process. Now, for every assessment year, for every SSE, you need to determine his or her or its residential status, and you need to tick under which box is it ordinarily resident or not ordinarily resident or a non-resident, right? So whether he is in India for more than 182 days and so he is ordinarily resident, whether he is in India for 60 days in the last year, more than 365 days in the preceding 4 years, that is why he is an ordinarily resident or what. This is a very important change, right? So while this section, I call it international taxation or foreign taxation, it is applicable on all the taxpayers, all the SSEs who are filing their returns. They have to, for every year, determine under which clause they are falling, right? So very important before you file the income tax returns. Now for any SSE, you have to determine the specific clause, and if you are a non-resident, just like the earlier years, you need to state the jurisdiction of residence, TIN number in the foreign country, etc. Income from business profession, if you go for the new rates, 115 BAC for an individual, BAB, etc. for a domestic or manufacturing company, then now you have to disclose. There are tick boxes, whether you are opting in for the first time, whether you are continuing, whether you are opting out of the new scheme, getting back to the old scheme, etc. Right? So you need to choose from the tick boxes, specifically if you are going for a new scheme or if you're going back to the old scheme in case of a individual resident or salaried SSE. In case of business profession, you need to disclose if you have made an investment in an unincorporated entity. This is very, very important. In fact, for many of the taxpayers, we have seen that there is an investment in some entity, right? But which entity it is, that is not very clear from the balance sheet, right? Many a times the PAN number of that entity is not available. Now by this, and you know the taxpayers, they go with the plea that okay, this is an unincorporated entity, this is a very old investment, etc. Now this will not do. You need, if it is an unincorporated entity also, you need to disclose specifically the name of the entity, type of the entity, PAN number, whether the entity is liable for audit, etc. Right? So a very, very important change which has come in the income tax return through a backdoor. It would not be visible very apparently, but this would have wide-reaching, far-reaching implications. In case of interest, which was disallowed under Section 43B for interest paid to or payable to deposit taking NBFCs, now you need to disclose how much interest was disallowed in the earlier years and how much is being allowed in the current year. Again, an important change for audit information, for in case of business, you need to get your books audited if your turnover is more than 1 crore. In case of profession, if it is more than 50 lakh. However, if your turnover is up till 10 crores and the cash transaction of purchase or sale is not more than 5%, then you would be exempted from tax audit. Now, in the income tax returns, you need to stick specifically if you are being audited or if you are not being audited, under which of the clauses do you fall. Specifically, if you are between a turnover between 1 crore to 10 crores or 50 lakh to 10 crores in case of profession, and you are not being audited, you need to tick the box that, okay, my cash value of the transactions is lot less than 5%. More importantly, you need to be careful that self checks, demand draft would come in the cash transactions. Therefore, while the government has said that this is ease of doing business, so that we don't want you to get tax audited if you have a turnover of less than 10 crores, but to calculate this 5% and to remove that self check and demand draft and include that in the cash transactions, this would take a doing, and you need to disclose this now. Very, very important. The moment you disclose, then you might, and if you are questioned on this, you need to give the data. So very important now to keep this data. In case of salaried employees, now this is a new schedule or new table which has been added. In fact, schedule which has been added on deferred ESOP. In case of ESOPs which are allotted, but are taxable on the happening of certain events, that is expiry of 48 months from the assessment year, or if you leave the company, or when if you sell the shares, etc. Now there is a detailed schedule for disclosing these ESOPs, right? And you need to state when were the ESOPs allotted during the relevant year, why are you taxable or why are you not taxable. And these 48 months, they would be determined from the return itself. So if say even after 4 years, you do not offer this for taxation, you would get a notice automatically on the basis of data analytics. Yeah, so this we have discussed. In case you choose alternative scheme, you need to disclose. Now, friends, amendments made in Finance Act 2022 vis-a-vis the Finance Bill. I would I would discuss only those amendments which were made post Finance Bill 2022. Most important, 194 capital R, TDS on any benefit or perquisite which have been provided to persons in the course of business or profession. So I will not go into the nitty-gritties of 194R because Rishabh would also require some time. He would be discussing very important facts, but the amendment 194R, now they have amended it further to add the words ensure that the tax has been deducted, right? This is a very important amendment. So if you are giving any benefit or perquisite, say for example, if you are giving your dealer, say you are a manufacturing company, you have dealers, you are giving your dealers a trip to Dubai, right, free on achievement of certain milestones. So now you are giving the trip to Dubai to your dealer where the value of the benefit is say 1 lakh rupees. Before this guy boards the plane, you have to deduct and pay the TDS. Because in my example, the entire benefit is non-cash. You have to pay it from after raising a debit note to the dealer, right? I am not getting into valuation, etc. There are a lot of issues under 194 capital R which we have raised. You can see our YouTube channel. There is a specific video on 194R because valuation becomes a problem. Say the manufacturing company who is giving this trip to Dubai free, he is spending only 75,000, but that is post discount. So whether the valuation will be pre-discount, post-discount, so many issues are there. For the resolving that, they will come out with a circular under 194R subsection 2 and 3, which have been inserted in Finance Act 2022, which was not there earlier in Finance Bill 2022. But important amendment again is before this guy boards the plane to Dubai, the TDS needs to be deposited with the government under 194R by the manufacturing company in my example who is giving this benefit or perquisite to the dealer. Section 2 subsection 12 capital A amendments to the definition of books of accounts. Now books of account would also include accounts in electronic form or in digital form. Well, many of the corporates ask me that scan copy of the invoices chalega. I have said even during the COVID times in 2020 that scan copy of the invoices, friends, will not do. Digital forms, if you see the Information Technology Act, it is very clear that invoices need to be signed with a digital signature, right? So you need to be very clear when you are talking about digital form. Scan copy of the invoices and then stating that this is a digital invoice and it is does not require any signature. This will not do as per my respectful submission. Section 56. In case of any movable or specified immovable or specified movable property, if the transfer has been made without adequate consideration, then it would be liable to be taxed in the hands of the uh, recipient under income from other sources if the value is more than 50,000 rupees. However, there was an exemption which was provided to charitable organization registered under 12A, 12AA, 12AB or 1023C. Now, this is a very, very important backdoor amendment which has been made for charitable organizations. In case the charitable organization receives any such transfer from a person specified under 13 subsection 3, that is from its trustee, from its beneficial trustee, and all those founders, all of those persons which are specified in 13 subsection 3, then this exemption would not be available. So if a trustee gives any asset which is more than 50,000 rupees to a charitable organization which is registered under 12A, to a temple, etc., to a temple school or any charitable organization, then even that now would be taxable and has to be offered for tax under section 56 subsection 2 clause 10. This is a very, very important amendment, friends. And for charitable organization, it needs to be taken care of in the coming years. Section 139 capit 8A, updated returns. There have been few amendments which have been made, wherein in case there is a survey, search, requisition of books of accounts, etc., previously an updated return could have been filed in case the survey, search, requisition was not made within 24 months of the year in which the updated return was being filed. Now they have removed this 24 months and made it any assessment year. So if you are subjected to search, survey, requisition in any assessment year, you would not be eligible to file an updated return under 139(8)(a). And also the return has to be a return of income. So if you have a loss in a specific assessment year, you are filing an updated return for that assessment year. Okay. You and the loss is reduced, or the unabsorbed depreciation that is reduced. Then for each such assessment year, you need to file separate updated returns. Okay. So this is the amendment. Surcharge education says not to be treated as income tax, no deduction allowable. There is a lot of discussion on this. Now they have introduced a new section 55 subsection 18 to state that in case in a previous year, in case of surcharge education says if any deduction was taken by a taxpayer, that would be considered to be as underreported income under 270 capital A. So now that needs to be offered for taxation, and the same would be it can be offered by the SSC suo motu, or it can be the AO can recompute the total income of the SSC of such previous year and make necessary amendments, and they would get 4 years time as available in section 154 for the same. Virtual digital assets, friends, section 115 BBH, as you all know, was introduced to tax virtual digital assets. You can call it cryptocurrencies, you can call it non-fungible tokens, etc. And the tax rate was 30%. However, no deduction other than cost of acquisition was available in case of taxation on transfer of virtual digital asset, right? Now they have made an amendment that even in case cost of acquisition, they have added the word cost of acquisition, if any. So if any has been added. So if you cannot determine the cost of acquisition, it will be considered to be as nil and you have to pay 30% on the full value of your transfer. Also, very, very important is that in case for one virtual digital asset, one VDA, and as defined under 247A, 247A again, very, very important, please go through that. So in case there is a loss in one VDA transaction, you cannot adjust it against another VDA transaction. They have made a specific amendment under 115 BBH to this effect also, right? They have removed this word other under any other provisions of this act. Now it is no loss can be adjusted against the gains from virtual digital asset. Friends, this clubbed with the fact that even in case a virtual digital asset is transferred and so and for another virtual digital asset, whether in cash or in kind. So if you know non-fungible tokens, you can just click a picture of this webinar and you can put it on the respective website. That would become a non-fungible token. And they have specific ledgers where through the software, these non-fungible tokens can be traded and there are ledgers. Even the money does not come to your bank account. Even then, they need to be offered for taxation. Now, many of the, even the tax experts, they say, how would the government come to know if there is a private transaction between two parties? Well, it is not whether the government will come to know or not. It is what is the law of the country. So even if there is a VDA transfer between two private parties, even then the amount needs to be offered for taxation, even if the money does not received in the bank account. And if there is a loss in one transaction of VDA, it cannot be adjusted against another transaction of VDA. We do await a circular on this, but it is our understanding that this is the intention of this amendment, which is made in Finance Act 2022 as against Finance Bill 2022. And of course, a TDS requires to be deducted under 194S. There is an amendment that this is notwithstanding 194 also. If you fall under 194O and 194S also, even then 194S would prevail over 194O. Friends, GST on virtual digital assets. There are various takes on that, whether GST would be applicable or not. Our take is very, very clear on this, that going forward, it is very clear that the government would want transactions in VDA to be covered under GST. It would not be regarded as a service. Our understanding is it would be regarded as a goods. Now, because of this Tata Consultancy Services decision, under 252, it is a movable property. It has utility, this VDA. It is capable of being bought and sold, and it is capable of being remitted, transferred or delivered. And therefore, in our understanding, it would take the nature of goods. The question is whether it would be actionable claim or not. Well, if they want to make this as an actionable claim, they have to have a separate class of actionable claim, which would require an amendment to the CGST Act 2017. So, which would be only done in the parliament. So what we see, they would resist from putting this VDA in the category of actionable claim, but they have all within their rights, they can put it under goods under 252. So let us see how this conundrum of virtual digital assets shape as far as GST is concerned. So now I would hand over the baton to my co-speaker Rishabh, who would take care of the notices under 148 and faceless assessment scheme. Rishabh, over to you.
I hope I'm audible.
Yeah, you're audible.
I'm just sharing my screen. Yeah. So we all know that Finance Act 21, which was also referred to as the Corona budget, brought about a slew of changes in how assessments or how reassessments would be done under Section 147, 148, 148A, the newly inserted section of the Income Tax Act. We were just getting used to the assessments being carried out in this manner. We had started receiving notices under 148A and culminating into a notice under 148 and then finally an order under 147, wherein the Finance Act 22 or the brought in a few more changes. Now, as practitioners, as income tax representatives, we all are aware that we have received a slew of notices about 148A, and I would just want to maybe highlight some of the changes which were already there and how they have been further strengthened or changed, along with the application of the old case laws under the old regime, how valid or how what are points of concern should be, and how we can address the issues being raised under Section 148. So, first of all, we all know that the Section 147 was reintroduced or substituted and replaced to by a first. Earlier, the Section 147 was a very lengthy section. Now, a very concise and brief section has been brought in, wherein it says that any income which is chargeable to tax in the case of an assessee uh, and which has escaped assessment can be subject to retaxes. What is important for us to understand, friends, is that the earlier words reason to believe, which were there in the earlier 147, have now been done away with. The earlier section 147 started with the phrase, if the assessing officer has reasons to believe that income has escaped assessment. Now, this has been all done away with, and though section 148 states that the assessing officer has information which suggests that income has escaped assessment, but for us to understand what is the implication of the word reasons to believe, removal of the word reason to believe is very critical. We've all been practicing with a slew of case laws which were available to us in the form of CIT versus Keventer of India Limited, 320 ITR 561 decided by the Honorable Supreme Court, which said that the reasons to believe had to be very tangible reasons, and it had to be directly related to the assessee to form an opinion that income chargeable to tax has escaped assessment. Now, however, if in my humble submission, I or we as a firm strongly believe that the word, even with the removal of the word reason to believe, the old case laws which said that reasons to believe has to be there is very applicable even today, because the words used in section 148 are information which suggest. Now, uh, the undisputed principle for reopening an assessment is that there has to be some income which has escaped taxation, and it has to be there has to be a direct nexus or a direct link between the income which has escaped taxation and the information which is there, linking the assessee to that information. Going by that logic, the even with the removal of the word reason to believe, uh, an argument, a very, very strong argument can be made under Section 148 while arguing for an order under Section 147 that the old case laws or the premises of the old case laws, that is to say, in the case of CIT versus Caventer India, or in the case of CIT versus Chandbal Rice Mill, which was again decided by the Calcutta High Court in ITR 203 ITR 168, that all these judgments still hold very, very important ground, and there has to be something very tangible, and the tangible evidence has to be culminated into information to apply the section of to apply section 148 of the Income Tax Act. Friends, it is also now very important for us to understand what is the meaning of the word information and how that has been interpreted by the courts throughout the history of the law. Well, just to give you a brief of some of the case laws, the word information has been analyzed by the Honorable Supreme Court in the case of Lawson and Tubro versus the state of Jharkhand. That information is something, and I quote it to you. Information means facts told, heard, discovered about something or someone. Even the law lexicon dictionary describes the word information as an act or process of informing, communicating, or reception of knowledge. Now, this only further goes on to prove that information should be something tangible and should have been discovered during the course of assessment by either coming from a third party source or from the internal assessment record itself. It comprehends not only a variety of factors from external sources, but also some internal sources, such as when you are making an assessment. The same word information has been again analyzed by the Honorable Supreme Court in the case of CIT versus A. Raman and Co. in the year 1968 in 671 ITR 11, and again in the case of Maharaja Kumar Kamal Singh versus CIT, that is 35 ITR 1, again by the Honorable Supreme Court. So going by all these judgments and in a conjoint reading with the word information, which suggests as stated under section 148, it is very, very clear that those case laws which were there, which defined what the word information meant, is still very apparent. In fact, just to maybe ponder upon a fact that in the earlier laws, before its amendment in 1989 and prior to that in 1987, the Finance Act 1987, prior to 1987, in section 147, stated that it has to be in consequence of an information in his possession. The assessing officer can only make a reassessment if there is an information, if it is in consequence of information in his possession. The word reason to believe was also added in 1987 and 1989, which was again removed in White Finance Act 2021. So this only goes on to state that we are going back to the old ways, and the words information, reasons to believe, all still have a very, very valid judgments today, and the old judgments that we've all been referring while making our humble submissions to the department still hold very, very valid ground. Some other case laws wherein information has been defined and which can be of very, very vital importance to us is our Sagar Enterprises versus ACIT in 257 ITR 335 by the Gujarat High Court, PCIT versus RMG Polyvinyl Private Limited in 396 ITR 5 by the Delhi High Court, Sugamal Rajpal versus SP Chalalia in 1971 in 79 ITR 603 decided by the Honorable Supreme Court. So this again goes on to prove that what is important for us is that the word information has to be very, very tangible, and it is our and it has to be some information which directly links the assessee to the information. Now, there have been other changes also. For example, the word "and" also, which was there, which has been interpreted by the Honorable Supreme Court in the Jet Airways India Limited case, that earlier what used to happen, that if an assessment was opened under information received on ground A, but during assessment it was found that ground A no longer holds ground and there is no income which has escaped assessment on account of ground A, but during assessment ground B comes into the picture, then ground B could not be assessed by the order of the Honorable Bombay High Court in the cases of Jet Airways India Private Limited. However, this has also been done away with now. While it has been said that uh, that the actual that even if the original ground on which assessment was made is not true or does not hold ground any longer, even if after during the assessment process, if an additional ground comes into the fold of the assessing officer, then irrespective of the fact that whether additions have been made on ground A, uh, additions could be made on ground B. Therefore, the Honorable High Court decision of the Jet Airways cases has been overturned and it does not hold ground any longer. Now, the safeguard which was available to the assessee after 4 years has also been done away with. Um, can I request Mr. Vinod Kumar Singhania not to send me annotations as we cannot share that. Mr. Singhania, if you can please stop requesting me to share the annotation of the shared content. Right. So Mr. Singhania, can you please stop requesting me to share the annotation of the content? Now, it is being said that the assessment can only be reopened for 3 years, whereas the earlier time was 4 years and 6 years. But the safeguard which was available to an assessee after 4 years has now been done away with, which goes on to state that even after 3 years, the assessment, or after 4 years, which was there in the earlier law, assessment can be made even if we have disclosed all the material facts truly and correctly. So a lot of hue and cry is there that whether this will tantamount to a change in opinion regarding an issue which can also be now reopened in 148. To my mind, the answer to this is no, subject to the fact that if the change in opinion is coming from uh, an audit objection or any other definition of information as defined in section 148, which we will cover in a short time. So change of opinion will still not tantamount to a ground for opening of income reassessment under section 148. Uh, so the old case laws in case of again CIT versus Caventor of India uh, or Capgemini India versus or in the case of Capgemini India still holds ground that change of opinion on the mere basis of change of opinion of the assessing officer, income escaping assessment or an reassessment under section 148 cannot be made. Now, coming down to the changes or coming down to section 148, which again was replaced and substituted by Finance Act 2021. The new section 148 states that before making an assessment or a reassessment, the assessing officer, subject to provision of section 148A, shall serve a notice on the assessee requiring him to file a return. What is Section 148A and the changes thereon and the applicability of old provision or old case laws or old judicial pronouncements with respect to that, we will cover in a short time. But Section 148 is merely stating that the assessing officer has to furnish a return or has to make an order to the assessee along with Section 148A(d) order requiring him to serve a file return. Now, at each level of Section 148A, earlier sanctions were required from the appropriate authority, whether it is a PCIT, whether it is a CIT, whether it is the additional CIT, as defined in Section 151. This now again has been done away with by Finance Act 2022, wherein it states that prior sanction of the required authority is not required if sanction has been taken while obtaining an order under Section 148A(d). So again, Section 148 further goes on to define what is an information, and there have been a plethora of changes which have come about by Finance Act 22 in the explanation 1 to Section 148, which defines what an information is. Based on what the definition of an information is, a assessing officer can issue a notice for assessment or reassessment. If the criteria specified in this explanation are not fulfilled, and if the information falls outside the purview of this explanation, then to my humble submission, it does not tantamount to information based on which the assessing officer can uh, issue a notice for assessment or reassessment. The first and the foremost, earlier what was there while Finance Act 21 was that any information which was flagged in the case of assessee according to the risk management strategies formulated by the board. Now the word flagged created a lot of hue and cry, and there was a lot of interpretation which was going on, that flagged meant that the risk management strategy actually had to implicate the assessee for the information, and it had to be a specific flagging for the assessee in that case for this explanation to apply. So while Finance Act 22, they removed the word flag. Now this has got a very, very wide implication, friends. Any information which is received by the assessing officer in accordance with the risk management strategies formulated by the board will now form a part of information. As we all know that the department is continuously going for further digitization of all records and digitization of all assessments, that and it collects information through a variety of sources, including from the stock exchanges, from the GST department, from companies law, and various other places. And on cross examination of these documents or this information, if any inconsistency is being found with respect to what the assessee has submitted in his assessment under Section 143(2) or while filing his return, then that can also become a information which the assessing officer has to open a case under Section 148 again. So the amplitude of 148 has now been increased manifold to include any information which the assessing officer receives from the risk management strategy. Now again, the risk management strategy which is formulated by the board, to my humble knowledge, is not a very, very public document. And most of the time the assessee does not know what is the risk management strategy formulated because it is not there on public domain. So if the risk management strategy is kept very, very wide, then there may be a situation that the assessing officer will start having infinite powers or very, very high power to issue a notice under Section 148 citing the information received from the risk management strategy. However, as assessees, while making our submissions under section 148A(b) also, we should always ask the assessing officer for a copy of the information as was defined in GTN grant shaft, the Bible for the procedure for section 148 earlier to the amendment, prior to the amendment under White Finance Act, that those those documents or those guidelines laid by GTN grant shaft should still be a part of our submissions to the department, wherein we should definitely ask the department to supply us the copy of the information, ask for copies of what adverse material or what deviation has the assessing officer found with respect to what we have submitted while filing our returns, what materials he has gathered, and if it is on the basis of a statement or any evidence from a third party, then the right to cross-examine, because the right to cross-examine is also defined, is also a fundamentally defined right, which has been again deliberated and debated by the Supreme Court in various judgments, uh, whether proper PCIT approval has been obtained and the copy of that approval. And lastly, the risk management strategy which has been formulated, which implicates the assessee or says that the has information which the assessing officer has is according to the risk management strategy. The second point which was there in the Finance Act 21 was any final objection raised by the CAG or Comptroller or Auditor General of India. Now, this raised a lot of hue and cry, wherein it was said that any final objection was only being should only be subjected to internal audit objections in the case of assessee were not being covered in this. Also, if the objection of the CAG was on grounds of a technical interpretation of the law that went against the meaning of information, and that was tantamounting to a change of opinion, which was not allowed, as we have already discussed by various case laws. So the government, in all its wisdom, modified the second clause of explanation 1 to state that any audit objection that the assessment has not been made in accordance of the provisions of the Act will now form a part of information which is available with the department to suggest that income has escaped assessment. So if we analyze this, there were there were a plethora of judgments which defined what objections could form a part of, or which could form a part of reasons to believe, or now information which is available with the assessing officer to state that there is some income which is escaped assessment. While introducing the revised second clause that any audit objection uh, that the assessment has not been made in accordance with the provision of the Act, the government has in effect overturned the decision of Indian and Eastern Newspaper Society versus CIT, which was decided by the Honorable Supreme Court in 119 ITR 996. Now, what this case stated was that I'll just give you a very brief of what this case was. In Indian and Eastern Newspaper Society, what it said was that a house property was, or a property was being rented out, and the income which was received was charged as business income. However, while the internal audit query stated that should not be a business income but should be an income from house property. Based on that, the assessing officer had reopened the assessment, which was finally decided by the Honorable Supreme Court that this is nothing but a change of opinion, or on the grounds of technical interpretation of the law, that the assessing officer had taken one view while making the assessment, while the audit party had taken the other view while finalizing or while reviewing the assessment. And because it was a change of opinion, this was outside the purview of section 148 and thus could not be opened. However, with this new introduction, that any audit objection that the assessment has not been done in accordance with the provision of the Act, now there may be a case where change in opinion due to audit objection, which is in contrary to the view taken by the assessing officer, will also be reassessed under section 148. In the second case, which I would like to discuss, is income tax versus PVC BDs Private Limited, which was again decided by the Honorable Supreme Court in 237 ITR 13. What this case basically stated was that certain allowances were made or certain deductions were made claimed under Section 80G while making the assessment. However, while review, audit party found out that the deduction under 80G were not allowed since the donee was not registered under 80G. Since this was a point of fact, therefore the Honorable Supreme Court allowed the reopening of assessment under Section 148 because it was a fact which had been overlooked by the department or by the assessing officer and not a point of law. The third case in CIT versus Lucas TVS Limited, again decided by the Honorable Supreme Court, wide 249 ITR 306. A similar position was taken that certain disallowances or certain deductions which were claimed were related to previous year or earlier years. Now, since this fact was overlooked by the department, the Honorable Supreme Court allowed Section 148. The Honorable Supreme Court allowed deduction of reopening under Section 148, and the rationale which was given was that it is a fact which was overlooked, and therefore it is not a change of opinion but a new fact which has come into light. Therefore, we see that originally how the Supreme Court interpreted it was that if there is a change of opinion due to audit objection, that could not be reopened under Section 148. However, with the revised provision under Section 148, with the revised explanation, clause 2 to the explanation 1, our humble view is that now there may be a case where, due to a change of opinion due to audit objection, which is in contrary to the view taken by the AO, assessments can also be reassessed under Section 148. After this, three further clauses were added by Finance Act 22, was that any information which is received by the treaty sharing agreement under Section 90 or 90A of the Income Tax Act or of the treaty sharing agreement will also form a part of information which is available with the assessing officer to suggest that income has escaped assessment. Any information collected via the faceless collection of information a scheme under Section 135, and any information which requires an action in consequence to an order of a court or a tribunal. So now the last point, friends, is again very, very important, as this has the effect that if any order of a court or a tribunal wherein it has taken a different view to a matter or to a matter, then also based on the difference of the different view which has been taken by the court or tribunal, it will be deemed that the assessing officer has information which for which reassessments can be made. Also, it is very, very important, and this, my friend, to my humble knowledge, is a very, very detrimental thing which the government has done. Earlier, by explanation 2, the government had deemed certain situations where it will be deemed that the assessing officer has certain information which suggests that income has escaped assessment. These cases included a search or seizure either in our own premises or in someone else's premises, a survey other than a survey under subsection 2A of section 133A, which is the TDS survey, assets requisitioned or seized in the case of any other persons for a search or survey conducted in their premises. So what Finance Act 21, it would be deemed that that there is information for that assessment year and 3 preceding assessment years, that the department has information that certain income has escaped assessment. Now, for the 3 preceding assessment years has been deleted by Finance Act 22. So what this would imply is that even while a simple survey, the department has the right to open your books for 10 years provided the size or provided the tax liability or the tax which are or the tax which are, or the income which is escape assessment is more than 50 lakhs uh, for 10 years. As practitioners, we always see that a regular survey happens with many of the clients. And even if there is no detrimental evidence which is found during the survey, just because the survey has happened, will give a right to the department to issue a notice under Section 148, even without complying with the provisions of Section 148A, and possibly reopen the books for the last 10 preceding financial years. This, my friends, as I have already stated, is a very, very detrimental thing and will only lead to a lot of further escalations of and a lot of further litigations and a lot of further scrutinies. Uh, so in section 148A also, like certain changes were made earlier by Finance Act 21. At every stage of section 148A, the assessing officer had to take prior approval of the appropriate authority before serving the next show cause. For example, to conduct an inquiry, he required a prior approval. Then then based on the reply of the assessee or to provide an opportunity to the assessee, he would again have to take a prior approval under section 148A subsection B, consider the replies, and based on the prior approval and based on the replies of the assessee, issue a notice under section 148AD, again with the prior approval of the specified authority. Along with the notice under section 148AD, he would be required to issue a notice under section 148. Now, the requirement for taking a prior approval under section 148 subsection B has been done away with if a prior approval has been taken for section 148A. To my mind, and this is practically what we have also seen, is that uh, a lot of times assessing officers used to take up approval while conducting an inquiry under section 148A and then issue a notice under section 148AD and 148 using the same approval. With the deletion of requirement for taking a prior approval under section 148AB, to our humble knowledge and to our humble understanding, it goes on to further prove that the assessing officer has to take a fresh approval while issuing a notice under section 148AD. Therefore, if in a case where the approval has been taken wide for conducting an inquiry under section 148A, that approval will not be deemed to be a good approval for issuing a notice under section 148AD, and the same can be challenged in the court of law to quash the notice under section 148AD, which we have practically seen happening in a lot of assessment orders that we are receiving. Uh, in a similar manner, a small change has been brought about in the by the AO in the deeming provision under section 148A, wherein now it will be deemed that the AO has information if some information has come from the scheme formed under section 135A of the Income Tax Act. A new section has also been introduced, section 148B, which is more of a jurisdictional section, that no order shall be passed by an officer below the rank of a JC in respect of situation where the officer is deemed to have information under section under explanation 2. However, the order can be passed below the rank of the JC if he takes the approval of additional commissioner, additional director, joint commissioner, or joint director. So what this section essentially states is that wherein the deeming provision of section 148 get applicable, that the assessing officer has deemed information of some certain income which has escaped assessment, the order cannot be passed below the rank of a joint commissioner without the prior approval of the appropriate authority. So friends, this is what, and so again, one small change has been brought about with, or a few small changes have been brought about in section 149, wherein the scope for issue of notice under section 149 from 3 years to 10 years has been drastically increased, which earlier said that only if it was represented in the form of assets, then only a notice could be issued after 3 years within a period of 10 years. However, now it has been expanded to my mind to include everything, wherein two more explanations have been added, that expenditure in respect of a transaction in relation to an event or occasion will also form a part of information or any entry in the books of account. So if I take an example, expenditure, suppose I have a marriage function for which I use unaccounted cash of say 60 lakh rupees. Even though that is not represented in the form of assets in my book, but because it is an expenditure now, it will still be liable to be opened for a period of beyond 3 years. Because earlier the judgments or earlier the interpretation which are coming out that if certain expenditures have been made, since they are not represented in the form of assets, they cannot be opened after 3 years. To plug that loophole, the government has brought about this. In a similar manner, an entry or entries in the books of account or any entry in the books of account which has the implication of more than 50 lakh rupees will again form a will again come to part that the assessment can be made up to 10 years. So to sum it up, if any unaccounted or if anything for more than 50 lakh rupees is there in a books of account, then it gives all the right to the assessing officer to open your books of account or to issue a reassessment order even after a period of 3 years. Also, one small change which has been brought about is that even if the investments or the expenditure has been made over a period of more than 1 year, if the combined value of that is more than 50 lakh rupees, then also such provision will apply. For example, if I'm suppose constructing a building and in year one I have spent 30 lakh and in year two I have spent 30 lakh more. Since the combined amount is more than 50 lakh rupees, then for each of such assessment years, the department gets a period of more than 3 years up to 10 years to issue a notice under section 148, 148A and make a reassessment. Friends, not many changes have been brought about in section 144B in Faceless assessment. For the paucity of time, I will just roughly go through that in the next maybe 2-3 minutes. As we all know that now any assessment is under a faceless scheme up to the CIT level, and the government is also contemplating to bring the assessment by the tribunal even at the under faceless. We know that the main reason why the government wants to do a facial assessment is to utilize the technology and the resources available. The objective of the government is to reduce the interference between the assessing officer. However, practically, if you look at it, that is not happening because a lot of the cases are still being transferred to the local jurisdiction for the assessment and to have a team-based assessment so that a dynamic jurisdiction can be established. To achieve the faceless assessment scheme, the government has made a national e-assessment center, which is at a national level. Under the National Reassessment Center, there are various regional jurisdiction or regional assessment centers, each having 4 units: the assessment unit, the verification unit, the technical unit, and the review unit. The department with the functions of each unit being categorized very clearly. Now, the method through which the assessment will happen, that any communication to or from the assessee will happen through the NAC. So if I write something that will go to the NEC, and the NEC will make a request to any of the AUs to make an assessment. So the and in a vice versa manner, if the AU wants any assessment or any document, it has to again flow back through the NEC. This will go on to and fro, and the mechanism which is prescribed is that any draft order will be issued to the assessee. If there is a variation in the draft order which is detrimental to the assessee, then the assessee has the chance to reply to the draft assessment order. If it is not, then the assessing, then the order is passed status quo uh, without any variation. Now, what is important over here, friends, which I would want to highlight, is that sometimes we are seeing that the assessing officers are passing orders and not giving, are passing draft assessment orders and not giving enough time to the assessee to reply to it correctly and in a justified manner. For example, if the draft assessment order is say issued yesterday evening, the time given to reply to is till today day end. And if the assessee is not replying it within a very unreasonable amount of time, even after that, the assessing officer is issuing the order under various sections. So, to my mind, this can again be challenged in the court of law that adequate opportunity of representing is not being given, and it is an unjustified amount which is being sometimes given. So this should also be kept in mind while making while facing a faceless assessment, as this is proving to be a very difficult or a draconian task for the practitioners, because orders are coming in sometimes very late at night, and the department is expecting the reply to the order in a very unjustified or a unrealistic manner. In a similar manner, even appeals to tribunals or CIT has been done in a faceless manner now, wherein a national faceless appeal center has been established, followed by a regional faceless appeal center and an AU, similar to what was there in the assessment or a reassessment. All communication and to and fro will be through the NFAC and vice versa. So, friends, with this I bring an end to my deliberation. And So, if anyone has any questions, I would be happy to answer them. Mr. Samir Gondolia, I will definitely send you the judgments. Please need not worry on that.
Rishabh, there is a question from Mr. Samir above that.
Okay, I'll just look into it. Return of income filed beyond due date mentioned in the notice. Sir, to my mind, it will not be a valid notice because the deadlines set in 148 are very absolute, and if it can be definite, as I was saying, if the deadline is a very unrealistic deadline, then the matter can be agitated in the court of law. But going by the strict interpretation of law itself today, it will not be considered as a valid return of income if it is filed beyond the due date.
Yeah, but that can be, taken up. What is reasonable? Now you have to have the right facts and right, law to it to justify that it is not a reasonable period of time which has been given to you.
Absolutely.
Hmm. So,
Is ITRs also? Yeah, Vivek, please continue.
yeah, please.
You were saying something.
No, there is another question. You
Yeah.
answer that and then we'll end.
Is ITAT also a faceless scheme? Sir, currently it is not, but there are talks which are going on. During the COVID time, it did go under a virtual hearing, but currently it is not under faceless, but we are expecting that to happen soon.
Yeah. So, thank you, everybody, for joining this. In May, we will again meet up and we'll again have another webinar on all the developments which have happened in April that would cover more topics on all the developments in April. Thank you for joining. Okay, Mr. Samruddhi Badak, could you please elaborate ESOP, which is to be introduced in Part B TTI? I had actually explained that. If you could leave us your email ID, we can send you separately on a note on this ESOP part, which has come in the income tax return. You leave your email ID, please, with us. We'll send you a note on this. Thank you, everybody. Thank you very much.
Thank you, everyone. Thank you.
Thank you, Vivek sir. Thank you, Rishabh sir, for this wonderful deliberation. Thank you all for participating in this webinar. We'll share the PPT shortly. We conduct webinar every month. So we look forward to welcome you all again. Thank you.